Right now, nearly 60% of American homeowners with a mortgage are sitting on an interest rate below 4%, while today's average 30-year fixed mortgage rate hovers above 7.5%. That 3.5 percentage point gap has created one of the most bizarre, underreported economic crises in modern U.S. history. Millions of people are trapped in homes they can't sell, even if they want to, even if they're sitting on hundreds of thousands of dollars in paper profit. This phenomenon has a formal name: the mortgage lock-in effect. And today, we're answering three critical questions. How did the biggest housing boom in U.S. history turn into a financial prison for 15 million American households? Why would people turn down a six-figure profit to stay in a home that no longer fits their life? And what does this frozen housing market mean for the future of the entire American economy? So how did we get here? This didn't happen by accident, and it wasn't caused by the usual suspects of greedy banks or reckless homebuyers. To understand the trap, we have to go back to 2020, when the global economy was staring down a total pandemic collapse. The Federal Reserve didn't just nudge interest rates down, they slammed them to near zero, a level only seen once before in modern U.S. history. For the average American, this wasn't just a boring line on a government graph. It meant you could borrow hundreds of thousands of dollars to buy a home, for less than 3% interest a year. To put that in perspective, that's cheaper than the inflation rate for most of 2021 and 2022. In real terms, banks were practically paying people to take out a mortgage. This was a once-in-a-lifetime sweetheart deal. Millions of Americans jumped on it. They bought first homes, upgraded to bigger houses, refinanced their existing mortgages to lock in those rock-bottom rates. By 2022, nearly two-thirds of all U.S. mortgages had a rate below 4%. No one could have predicted that just 12 months later, that deal would turn into a financial ball and chain. By mid-2022, the U.S. housing market was at its absolute peak. Home prices had jumped 40% in just 2 years, the fastest increase on record. Homeowners were sitting on more home equity than ever before. On paper, they were richer than they'd ever been. But from here on, it gets even worse. The Fed, desperate to fight sky-high inflation, launched the fastest interest rate hiking cycle in its history. In just 18 months, rates went from near zero to over 5%. Mortgage rates doubled, then doubled again, hitting 8% in late 2023, a level not seen in 23 years. And that's when the absurdity set in. Let's take a real representative example. A young couple in Austin, Texas, bought a two-bed starter home in 2021 with a 2.75% mortgage, paying $1,800 a month. Today, that same home is worth 40% more than they paid for it, a $180,000 paper profit. But if they sell it to buy a four-bed family home for their two new kids, even with that massive profit as a down payment, their monthly mortgage would jump to $3,600 a month. That's a 100% increase, just for a home that fits their life. They're sitting on a six-figure windfall, but they can't touch it without bankrupting themselves. It gets even more ridiculous. A retired teacher in Florida wanted to downsize from her three-bed family home to a one-bed condo to cut her costs and be closer to her grandkids. She's owned her home for 15 years and owes less than $50,000 on it. But even if she sells her home for $450,000 and puts $400,000 down on a $420,000 condo, her monthly payment on that $20,000 mortgage at 7.5% would be higher than her current payment on her $50,000 loan at 3%. Let that sink in. She'd pay more every month to borrow $20,000 than she does to borrow $50,000. And the unintended consequences? They're everywhere. The number of Americans moving across state lines for work has dropped to its lowest level since World War II. People are turning down promotions and higher-paying jobs because they can't afford to relocate. We're seeing a rise in multi-generational housing, not by choice, but because growing families can't upgrade from their tiny starter homes. The American dream of homeownership has turned into a one-way ticket. Let's dive a little bit deeper into the economic mechanisms at play here. This isn't just a people don't want to move problem. It's a textbook example of two core economic concepts, the mortgage lock-in effect and adverse selection in a frozen market. We've already covered the lock-in effect. When your existing mortgage rate is far below the current market rate, the cost of moving becomes prohibitively high even if you're selling your home for a massive profit. It's like being given a lifetime 50% discount at your local grocery store, but you can only use it if you never leave your town. Leave, and you lose the discount forever. For most homeowners, that discount is worth $500 to $1,500 a month, money they simply can't make up with a higher salary or a cheaper home. Then there's adverse selection. In a normal, healthy housing market, 70% of home sales come from people making regular life choices, moving up to a bigger home, downsizing after retirement, relocating for a better job. But today, those people are all locked in. The only homes hitting the market are from people who have to sell, divorce, death, job loss, or financial ruin. That means the market is flooded with distressed sales and almost no voluntary supply. It's why home inventory in the U.S. is still 40% below pre-pandemic levels, even as prices stay stubbornly high. So what have policymakers, banks, and homeowners done to break this trap? Almost every solution has fallen completely flat. The Biden administration rolled out a plan to cut closing costs for first-time buyers, but that does nothing for the millions of existing homeowners trapped in their mortgages. Some states have pushed for wider use of assumable mortgages, which let a buyer take over the seller's low interest rate. But these are only available for certain government-backed loans, and banks hate them because they lose out on years of higher interest payments. Even the bank's own solutions are a joke. Many now offer rate buy-downs or mortgage modifications, but they charge thousands of dollars in upfront fees, and the new rate is still far higher than the 3% deals homeowners already locked in. For most trapped homeowners, the only DIY option is to rent out their old home instead of selling it, but that means becoming a landlord, with all the risk and cost that comes with it, and still having to qualify for a second mortgage on a new home. For 90% of people, it's simply not an option. Today, the trap has closed completely. More than 15 million American homeowners are locked into their mortgages. That's nearly 60% of all mortgaged homes in the country. The National Association of Realtors reports that home sales are at a 13-year low, not because no one wants to buy, but because almost no one can afford to sell. And the worst part? This isn't just a housing problem. It's rippling through every corner of the U.S. economy. When people can't move for better jobs, the labor market gets stuck. Small businesses in fast-growing states can't find workers because people can't relocate. Retail sales suffer because people aren't moving and buying new furniture, appliances, or home goods, a sector that makes up nearly 10% of U.S. GDP. Even the rental market is broken. Trapped homeowners aren't selling, so there are fewer entry-level homes for first-time buyers who are forced to rent forever. That's driven rental prices up 25% since 2020, making housing even less affordable for the millions of Americans who don't own a home at all. Interestingly enough, the people who got hurt the worst are the ones who did everything right. They bought homes they could afford, locked in low rates, built equity, and played by the rules. Now, they're the ones trapped, unable to make the next step in their lives, while the Fed and policymakers stand by and watch. At the end of the day, this trap isn't an accident. It's the inevitable result of a decade of ultra-low interest rates, followed by the fastest rate-hiking cycle in Federal Reserve history. The American dream was always built on homeownership, the idea that your home is your castle, your safety net, and your ticket to build generational wealth. But today, for millions of Americans, that castle has turned into a prison. They're sitting on record wealth on paper, but they can't use it. They can't move, can't upgrade, can't downsize, can't take that better job, can't live the life they planned. And until something breaks the cycle of high rates and frozen supply, this trap will only get worse. If you want to learn more about how the Federal Reserve's interest rate decisions impact every part of your financial life, check out our video on why the Fed still can't get inflation under control, linked in the description and on screen right now. And if you enjoyed this deep dive into the hidden economic forces shaping the U.S. housing market, be sure to subscribe and hit the bell icon so you never miss our next breakdown.